You've probably noticed that everything is collapsing if you haven't been living under a rock. From their most recent highs, stocks are down about 20%. Up to 90% of the leading cryptocurrencies have experienced declines. Both home prices and GDP, a measure of our economy's output, are declining. No, hold on. There seems to be an error here. It seems that real estate costs are continuing at all-time highs. The housing market is absolutely absurd. When looking at houses for sale in our area, we discovered that there are just 7 possibilities available that have 3 bedrooms and 2 bathrooms and are priced around $300,000. Hey, welcome to Stock Market Mate. The reason we're talking about market crashes is that high-quality dividend-paying firms are often one of the finest investments you can make during uncertain economic times. So in order to give you dependable dividend income during these historic times, here are 7 of the best monthly dividend-paying ETFs. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Number 7. PFF iShares Preferred and Income Securities ETF. So in no particular order, we have PFF, also known as iShares Preferred and Income Securities ETF, which comes in at number 7. This ETF was created to mimic the performance and yield of the S&P US Preferred Stock Index, which has 495 stocks in total. Due to preferred stockholders' greater claim to dividends than common shareholders, this ETF offers exposure to preferred equities in the US, which is interesting to investors. For instance, preferred shareholders often have the right to receive payment in arrears before the dividend may be reinstated for common shareholders in the event that a firm encounters financial hardship and decides to suspend its payout. In essence, it's a safer method of stock ownership. If the company declares bankruptcy, your dividend and investment are both safer. PFF has a wide range of holdings. Its largest position accounts for just 3.51% of the entire fund. However, this ETF owns businesses like Citigroup, Wells Fargo, Bank of America, and Broadcom, which are more concentrated in the financial utilities and industrial sectors. This ETF now offers a rather high dividend yield of 5.11%, and over the past 10 years has had an average annual return of 5.09%. If you assume that you reinvested your dividends to further compound the returns on your investment, this indicates that if you had put $10,000 in this ETF 10 years ago, your investment would currently be approximately $16,429 or so. Additionally, this fund has an expense ratio of 0.4%, which is about average. This implies that for every $10,000 invested, you would spend $40 a year in expenses. Overall, if you're looking for a well-diversified portfolio of favored US stocks with a moderately high dividend yield, this ETF is an excellent option. Number 6. DIA or SPDR Dow Jones Industrial Average ETF Trust. 6th place goes to DIA, generally referred to as the SPDR Dow Jones Industrial Average ETF Trust. Up to 30% of the top blue-chip stocks in the US are represented in the Dow, and this ETF was created to reflect that performance. The Dow doesn't actually have any set criteria for which corporations to include. Instead, a more qualitative method is employed. It is believed that in order for a firm to be listed in the Dow, it must have a stellar reputation, exhibit consistent growth, and attract a sizable number of investors. All the companies that are part of this ETF are likely familiar to you or have had some impact in your life. Large corporations like Apple, Home Depot, Coca-Cola, McDonald's, Walmart, and Disney are among them. DIA only pays a dividend of 1.83% at the moment. In comparison to many of the ETFs on our list, we are aware that is not a particularly high price, but generally speaking, an ETF is more likely to see a stronger gain in terms of price appreciation over a sustained period of time the lower its dividend yield. And DIA has adhered to this general principle given that it has, on average, returned 12.73% annually over the past 10 years, the greatest return on this list. Accordingly, your investment today would be valued at around $33,143 if you had put $10,000 into this ETF 10 years ago. Number 5. PGX, INVESCO'S Preferred ETF. The 5th ranked preferred stock ETF is PGX, or INVESCO'S Preferred ETF, which has investments in 297 different stocks. Expect a large income but less capital appreciation on your investment than with the previous ETF we recommended, which was more of a capital appreciation play. PGX invests in firms including Citigroup, JP Morgan Chase, and Wells Fargo and is more heavily weighted towards the banking industry. with a current dividend yield of 5.69% and a 10-year average return of 4.91%, this fund is currently performing well. It follows that an investment of $10,000 made in this index ETF 10 years ago would now be worth $16,150. Additionally, PGX has an expense ratio of 0.51%, which is slightly higher than average and charges $51 yearly for every $10,000 invested in this fund. Number 4. SDIV Global X Super Dividend ETF. The Global X Super Dividend ETF, better known as SDIV, is at number 4 on our list. It tracks an index of 119 equally weighted firms that are among the top dividend players globally. With monthly distributions for more than 20 years, SDIV has a great track record of paying dividends, but access to the world stock market is perhaps the main benefit of owning this ETF. The ETFs we have mentioned thus far have all been concentrated on US stocks. You might want to consider diversifying your portfolio away from US stocks by buying a global stock ETF like SDIV, given that the US is still experiencing record inflation despite the Fed's efforts to reduce it by hiking interest rates. You can see that a sizable portion of the ETF's holdings, in addition to US companies, are foreign stocks from nations like China, Hong Kong, Brazil, and Britain. Although SDIV currently offers a staggering 11.16% dividend yield, during the past 10 years, the stock has only generated an average annual return of 1.01%. Therefore, an investment of $10,000 made in this ETF 10 years ago would only be worth $11,057 now. Therefore, we once more observe an inverse relationship between dividends and capital gains. Number 3. DHS WISDOMTREE'S US High Dividend Fund. DHS, a US high dividend fund from WisdomTree, is ranked 3rd on our list. DHS excludes businesses with a market capitalization of less than $200 million. It tracks a dividend-weighted index of US businesses that pay high dividends. Due to the fact that its top holdings account for roughly 50% of the portfolio and the largest portion is made of firms like ExxonMobil and Chevron, this ETF is still well diversified but not as well diversified as some of the others in this list. This ETF currently owns 386 stocks in total. Currently paying a 3.6% dividend yield, DHS has one of the top 10-year returns on this list with an average annual return of 11.73% over the past 10 years. Additionally, a $10,000 investment invested into this fund 10 years ago would today be worth $30,318. Additionally, this fund has an expense ratio that is somewhat below average at 0.38%, costing you $38 yearly for every $10,000 you have invested. In general, this is a wise choice. In contrast to the other dividend ETFs on this list, DHS is more concentrated in the energy and pharmaceutical industries and offers a strong dividend yield. Number 2. DIV Global X Super Dividend US ETF. The Global X Super Dividend US ETF, better known as DIV, is ranked number 2 and provides exposure to 51 of the highest dividend-paying equities in the US. DIV searches for equities that have little volatility compared to the S&P 500 when deciding what to hold. Because volatility affects us as investors, this is a good thing. We prefer consistency. The best return with the least amount of volatility risk is what we seek. The aim of DIV is to include the stocks that pay the highest dividends while posing the least degree of risk. DIV was established a little less than 10 years ago and today provides an extremely high dividend yield of 6.23%. Therefore, we are unable to examine a 10-year return. However, this fund has had an average annual return since inception of 4.84%, and its average cost ratio is 0.45%, a yearly expense of $45 for every $10,000 invested. Number 1. SPHD INVESCO'S S&P 500 High Dividend Low Volatility ETF. The S&P 500 High Dividend Low Volatility ETF from Invesco, SPHD, comes in at number 1. This product invests at least 90% of its assets in S&P 500 stocks that have historically offered high dividend yields and low volatility. The 500 largest and greatest firms in the US make up the S&P 500 index. This ETF is essential for your dividend portfolio since it selects the 500 businesses with the best dividend yields and the lowest volatility. This ETF pays a 3.65% dividend yield and currently owns 51 companies. And those are our current top 7 dividend ETF recommendations. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video.
If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!